Hi, I'm Merryn Somerset Webb, Editor-in-Chief of Money Week magazine, and welcome to another one of our video interviews. I'm here today with Craig Yeaman, who is the manager of the Saracen Growth Fund, and we're going to talk a bit about the fund, a bit about how he invests, and a bit about what he's interested in now, which I'm pleased to say are some things that we are also interested in. So, Craig, tell us a bit about the fund.
Morning, Merryn. Yes, the fund that I run is called the Saracen Growth Fund, and it's been going now for 17 years. We've had good performance since launch.
Well, I wouldn't bother interviewing you if you hadn't, Craig, to be honest.
And we've outperformed 14 years out of 17. And since I took over stewardship of the fund in the beginning of January 2009, we've outperformed 6 years out of 7. So that's very good.
So that makes the cumulative return, or the annualised return?
Annualised returns about 12.5% since launch. So we've handsomely outperformed the market. Since launch, we've returned 480%, and the total return on the all share is about 109% since launch. So we've done relatively well.
Yeah, that's genuine outperformance. We're impressed.
That is. And the way we think we achieve that is we run a concentrated portfolio. So we will invest between 30 and 45 stocks at any one point in time. At the moment, I'm actually investing in 30 stocks. So I'm very confident with the companies that I own.
So when you say you invest in between 30 and 45, do you have any hard limits there, or is that just what you feel you can find that's good?
Yes, I don't like to run long tails of stocks because quite frankly, if I'm sitting with 0.5% in a stock and it doubles, it doesn't do much for performance. And if it halves, it doesn't really cost me much. So our view is we invest for the long term. We do a lot of work at the beginning of the process. We put in sensible risk limits. So for example, we will invest up to 7.5% in any one stock. And the reason we don't go above that limit, which is a hard limit, is because what if we're wrong? And we've, say, got 8 or 9 or 10% and it goes wrong, it really does cost you. So from a risk management point of view, we'll only go to 7.5.
Okay.
But we are finding a lot of value, Merryn, in the small and mid cap. And I think maybe some potential shareholders are surprised in that.
So just back to that, have you always been biased to small and mid cap, or are you saying that at the moment this is where you're finding the value?
At the moment, this is where we're seeing value. So when I took over stewardship of the fund at the beginning of 2009, we had 60% in large cap. So we are an all cap fund, but that's where we saw more value. And actually what you've seen since then, obviously the percentage of FTSE fell quite dramatically in the fund, and the small and the mid cap actually increased. So at the moment we're sitting with roughly 18% in FTSE 100, with the remainder being in the small and the mid-cap end of the market.
Okay. With any particular sector bias?
We have at the moment, yes. For many years we had no banks, we had no miners, we had very little in oil, and that actually is still the case. So at the moment we have one bank in the fund, which is Lloyds Bank, and we just actually initiated a holding about 4 months ago.
And you haven't had banks up until now because why? Because they're complicated, ridiculous, overpriced?
And they're very difficult to analyse, and we just felt the risk reward was not in our favour.
And there's the political risk in there as well.
There's still the political risk. So for example, I could have bought Lloyds at 20p, but to me there was far too much risk associated with it. So we initiated a holding at 70 pence, which, okay, in hindsight it would have been great to buy earlier, but to me, there, as I say, there was too much risk, and I wanted to have more certainty. And obviously now we know the government is selling its stake. In terms of the capital position of the bank, they're in a very strong position with their Tier 1 ratio, and we think they are paying a dividend, but it's a nominal dividend, and that will change over the next couple of years. So Lloyds is perhaps not a stock you would associate with Saracen Growth Fund, but it's a stock that we think will make a lot of money on over the next 5 years.
Okay, and so back into one bank and back into miners.
One miner.
Tiptoeing in here.
we're very much tiptoeing in here. And the interesting thing is everyone to a man is against miners. They're all negative because we've seen the iron ore price fall from $165 a tonne back in 2011. It's currently at $40. Now, the way the market works is the market thinks it'll always be $40, and we don't think that's the case. Demand supply imbalances will come back into the market, and actually Rio's, the stock that we've bought, is in a very strong position financially. Its gearing is at the lower end of its range of 20 to 30%. Even with commodity prices being where they are, they're still making 40% operating margins, and actually they've increased their dividend by 12%. Now that's a great sign for investors, but of course investors in the market are focused on the next quarter, the next half year. Now, to be fair, we don't really concentrate on that. So we're not calling a bottom. to the commodity cycle, but we know prices of copper, iron ore, etc. will not always be at this level, hence the reason we've got in. And
but we're not seeing, if you look at the supply side, we're not seeing yet the major cuts to production in resources that you would like to see before you can begin to think it's a proper bottom, right? The supply side is going to continue to be pretty overdone for some time to come.
What you are seeing is, and it's interesting, the Rio chief exec said this other day, some of his competitors are hanging on by their fingernails.
Yeah.
So we expect supply to be coming out of the market. Demand will obviously increase at some point, and at that point the likes of Rio's and BHP Billiton, to be fair, will be in a very strong position. And what you'll probably see is there will be a snap in the prices of these commodities. But an interesting stat actually, Merryn, is the market cap of BAT is more than the entire mining sector in the UK. That's quite a frightening stat, considering you have the likes of BHP, you have Rio's, you have Glencore, along with Anglo American and some of the others. Yeah. So really, these are unloved stocks, and actually, we're being paid to wait at the moment. So Rio Tinto is yielding 8%. Now, when you see a company yielding, say, 8%, you think the dividend's at risk. Yes. We actually think that the dividend of Rio's is not at risk. We've met the company management team twice now, and they've basically said, all things being equal, this dividend is sacrosanct. And the fact that they increased it by 12% gives us a lot of confidence. So these are two areas that really we're underweight at the moment. As I say, oils were underweight. We have been for a period of time as well.
And you're going to stay underweight oils? That doesn't fall into the same criteria as the miners for you?
No, it doesn't actually.
Why is that?
We think the miners are more stable in terms of their balance sheets. If you look at the capex, for example, the miners can cut their capex much more quickly than the oil companies. So if you look at Shell, for example, their capex is over £20 billion. Rio Tinto is much less than that, with half of it being maintenance and half of it being growth capex. So financially, we think they're in a stronger position. So the only oil stock we own is BG, and that's obviously trading at a discount to where it should be, theoretically, given the fact that it's been bought by Shell.
Yeah, and do you have a view on the oil price?
No, we don't really have a view. Obviously at the moment, Brent is very low, very low, it's about $36. And over the long term, we would expect that to increase, but I can't sit here with a crystal ball and say this will happen over the next year or 2 years. But over the long term, we would expect it to increase. Okay,
so we go back briefly to BAT and it having a market cap larger than all that of the miners. Now, I'm assuming you are not invested in tobacco stocks.
We're not. No, we're not invested in tobacco stocks.
And is that a moral decision or a price decision?
It's not a moral decision. No, it's not. It's purely a price decision. These companies have been phenomenal in the past. But actually, if you look at the valuation that they're trading on, they're not bargain basement. So it's not an area that we're invested in, but it's not because of morals.
But you'll find that the majority of the big funds in the UK will be heavily invested in tobacco.
They will be. And actually, Merryn, if you look at where we're invested, going back to the beginning of the conversation, we are predominantly small and mid cap. So the new buzzwords around funds are your active share. The active share of Saracen Growth Fund is 94%.
The active share, just for readers who aren't au fait with all these numbers, is the extent to which your holdings are separate to those of the index.
Correct, how far away from the benchmark you are. So we really are a pure bottom-up stock picking fund.
Yeah, and from my point of view, or from our readers' point of view, this is very important, because if we're going to buy an index fund, we'll buy an index fund. If we're going to buy an active fund, we want to know that it's genuinely active and it's very far away from the index.
Absolutely, because if you're paying an active management fee, you want your fund manager to actually manage that fund actively. And by that, I mean not buying and selling shares all the time, but actually taking decisions, proactive decisions, and actually investing the money in the best place he or she thinks that they can get investment for you.
What's the average holding period for one of your stocks? I know you're long-term investors. What does long-term mean for a stock?
Well, long-term for us means about 5 years. So if you look back historically at this fund, the average portfolio turnover has been between 20 and 25% per annum, hence a 4 to 5 year investment horizon. But we've held shares for more than that. For example, and this company is not flavour of the month at the moment, but the Weir Group, we've held the Weir Group since 1999. So we've held it since the launch of this fund. And obviously in the past we've had a much higher position than we do at the moment. But that gives you an idea of what we're trying to do. Because for us, we're not clever enough to tell you what the market's going to do over, say, the next 3 months or the next 6 months. We're about investing for 3 to 5 to 7 years' time.
Okay. Now, we talked about sectors you're underweight in, sectors you're just beginning to get into. What are you overweight in?
Well, we're overweight a few sectors, but I have to stress this to your readers. This is not the way we look at.
Yeah, you look at individual companies, but you end up in sectors.
But we do end up in sectors, absolutely. And an area that we are overweight is in industrials. And once again, this may come as a surprise to some of your readers, because we know there are a lot of problems out there. But we are overweight industrials, and so we have companies as diverse as Avon Rubber, Hill and Smith, the Weir Group, which we've touched upon earlier. GKN is one of the largest holdings in the fund. Now, GKN is a stock that I bought after taking over running of the fund back in 2009, and we initiated a position at the end of 2009. So we've now held that for a number of years, and to us this represents extraordinary value. We're buying GKN today, and we still are buying it, on a price earnings ratio of less than 10 for next year. Now, that to me feels like the wrong level, because this company is doing very well in its end markets of automotive and aerospace. It's recently bought another company in the aerospace sector called Fokker. Margins are increasing, and of course we know what's happening with the civil aerospace side. You know, the likes of Airbus and Boeing have got long order books, so GKN are really benefiting.
Okay, we talked about, well, you've just talked about value, and you refer to it in terms of PE. Is it, what other metrics do you use? And when you look at something and say, this is cheap, it's not just PE, is it?
It's
what
not
else
just
is it?
PE. I mean, we look at DCF, which is discounted cash flow. We look at NAVs, net asset values, if we're looking at property companies. But if we do come back to say a PE, what we're trying to identify, Merryn, is stocks that will be trading on a PE of 10 or less in 5 years' time. So this doesn't mean that we won't buy stocks that look expensive today if we can see the growth coming through in a 5-year view. And that's what we're trying to identify, because we believe that if you can identify stocks on a PE basis, 10 or less, in 5 years' time, you'll do very well from a stock. So to us, 10 or less is buy territory. Between 10 and 15 times we would call it hold, and 15 and above looks very expensive.
Okay, so the average P in the fund is well below 15.
The average P of the fund on today is actually less than 15, or in a 5-year view is way less than 15.
Okay, interesting. And what about yield? I mean, obviously you're not an income fund, you're a growth fund, but our readers are often looking for yield.
Absolutely.
What do they get from your fund?
Well, at the moment, the yield isn't that attractive if you look at yields that you can get in the market. So we're yielding just less than 2%. But like anyone else, I like companies that pay dividends. I like companies that pay growing dividends, because I think it's very important for management teams, for directors, to actually have this as a goal. You know, what they don't want to do is to cut dividends. And it's also a sign of the health of the business. So of course, where I invest in the market, a lot of my companies are pre-dividend or just starting to pay dividends. But when we meet with a company, we have to look at their 5-year projections, not just for dividends, obviously, but how the business is going to grow over time. And if a company is generating excess profits, then of course they do pay dividends. That's what happens. But a number of our companies also pay special dividends. Now that's something you can't rely on. But if you look at companies such as Victrex, Victrex have paid a number of special dividends over the years. Dunelm, which is a recent holding in the fund, has paid a number of special dividends over the years. And Elementis pay a rolling special dividend.
So it's a rolling special dividend. Is it a special dividend? Or
Is
it just a dividend?
It's unusual. They have a special dividend policy. So they have their ordinary dividend, which they want to increase. But in addition to that, they will pay up to half the net cash in the balance sheet every year as a special dividend.
Right.
And because it's a very cash generative business,
there's often a lot of it.
So unless they can find other uses, and we love them to find other uses, if they acquire companies or invest in a slightly different area or different technology, they will hand that back to us.
Lovely.
So that's very
So
useful.
when you go and see a company, because clearly you're going to visit all the companies that you're invested in, what are you looking for? You're looking for a 5-year plan that involves a dividend at some point. You're looking for evidence that growth is building, etc. What are you asking the management?
We're asking the management a number of questions. Obviously, we want to know about the business model, as you alluded to. What is their 5-year business model? Because if a management don't have a model for 5 years, we're not interested. How can we possibly model that company? We want to know what they're thinking about their end markets, how they're finding their customers at the moment. And obviously with meeting managements, they're a bit more candid in the meeting than they would be to the city. Now that's not to say they're giving us any extra information.
No, of course not.
But you know, it's something that we can discuss.
Yeah.
And of course, because we're long-term shareholders in companies, we get to know the management well. And so you do build up a rapport with them.
Excellent. Now, just before we finish, have you got a favourite stock, the one you've bought most recently, or the one stock you think is most interesting in your portfolio at the moment?
Well, we have a number of interesting stocks, Merryn.
I'm sure you do.
Well, the company that I would highlight, and it's not a new stock, but it's a stock that we've held now for, it's about 3 years, and it's a company that many of your readers may not know about, and it's called MJ Gleason.
Okay,
Now,
tell us about it.
I will tell you about it. Gleason has 2 divisions. It has an affordable housing division in the north of England. So they'll basically build houses between, say, Newcastle and Stoke, Hull and Liverpool. That's their natural territory. And they also have a strategic land buying division in the south of the country where they will buy land, they will gain planning permission, and they will sell it on to the likes of Persimmon, Bellway, Bovis, Barrett. But the main division is the house building. And the advantage they have is land is cheaper in the north of England than the south. So their average plot costs are about £10,000 a unit. So that equates to about 9% of the selling cost. So when I talk about affordable housing, I'm not talking about social housing. So each house that they sell is to a private buyer. So they're selling for average about £120,000 to £125,000. And what we like about the company is, firstly, they have a large management stake. So the chief executive owns about 4% of the business, and other directors own a lot. We like the fact that they have a 7-year land bank, so they future-proof themselves. They are getting some price inflation. So although they don't need prices to increase for them, they are seeing some inflation. It's nice to have. And they've got cash in the balance sheet. So they're in a very, very strong position. And coming back to the dividend discussion that we had earlier on, they've just recently initiated a dividend, and we expect that dividend to increase materially over the next 5 years. So what we like is, at present they're building about 800 houses a year, so it's a very small house builder, but they have plans to get that to 1,500.
This is interesting, because there aren't that many small house builders left in the UK, are there? It's become a very concentrated sector.
It is. If you look at the larger companies in the sector, Barrett's, Persimmons, Barclay Group, which we also own, then there are large builders. If you look at MJ Gleason, and MJ Gleason is our largest position in the fund. Now, we bought it when it was about £1.50 a share. We're trading today about £4.70.
Would you buy it again today at that price?
I would buy it today again at that price. Unfortunately, because we do have rules that say I won't go above 7.5%, I can't do it. But if it was a lesser position, I would. They actually had a positive profit warning just last week. And it's not often you're getting companies saying, actually, things are better than we said they were going to be. So they've actually their brokers increased by 9% recently. So it's a very strong company. It's in a niche area of the market, and they're doing very well. So that's certainly one that I would highlight to your readers. But other companies that they were very keen on, STV, so that's Scottish Television. And we bought Scottish Television in 2010. And in all honesty, we bought it 3 years too early. But this shows you that we don't panic because things aren't progressing as we hoped in share price terms. And in 2013, the share price went up 200%. Last year it went up 100%, and this year it's up 20%. And actually still a very cheap share. So
would you buy that one again?
We would buy that one again, absolutely. We have actually been adding to the holding. So you just think of a mini ITV, and it's doing very well. And it's on a single-digit rating. The debt is coming down nicely. They're on top of a pension deficit that used to be a problem, and it looks like a very solid company now. So I would highlight STV, but a new company that I've bought recently is Pets at Home. Now, Pets at Home is really a category killer in what it does. Yeah. It's much larger than its nearest competitors put together. It is, it's got a flourishing veterinary arm that will do very well over the coming years. It's got involved with grooming pets, so you don't just go in and buy the pets or buy the pet food, but you actually go and get your pets groomed as well. And although that's only a very small part of the business, the management think that there's a lot of growth to come from it. So that's a company that on today you would say looks fairly valued, but over a 5-year view it looks very good value to us, and we've actually been topping up our position recently.
Okay, thank you. 3 really interesting stocks to think about. Thank you, Craig.
Thank you, Merryn.
Cash is actually going to be a very good investment because under deflation, the value of cash goes up every day. And the other thing about this, what we're looking at today, people who remember 1973 and the oil price shock of the Arab oil boycott, that was the day, almost, those few weeks where people suddenly got the idea, what I ought to do is I ought to borrow as much as possible and I ought to buy as quickly as possible.